These are the 10 most asked questions by investors in money market funds. And the first question is, can I ever grow enough wealth in a money market fund? And this is my take. And I say that money market fund and any other scheme of investment that has ever been created, those are businesses that belong to individuals, and they are primarily tailored to generate wealth for the owners, and secondarily tailored to maximize the wealth of the owners. Refer or ask any good lawyer and he will talk to you about the Aziminic case that establishes the primary and the secondary business of any enterprise that enjoys the LLC status. With that back in our mind then, it is your primary duty as an investor, as an individual, to know the reason why you want to get into investment. You need to have a purpose. And this purpose or reason, which now I call a goal, need to be SMART. SMART acronyms that look at the properties of a good purpose, good goal that you set for yourself. Because once you have set that goal, you will also primarily have to determine the effective, sustainable way that you are going to achieve your goal. Because the main mistake that most of us do in investment is jumping into a platform because you heard it from another person, your friend is in it, without looking at yourself and your needs, your goals, and evaluating whether that scheme or plan suits your purpose. Whatever goal that you set must be measurable. Measurable in financial terms, such that if you have set a goal to accumulate or invest towards attaining a figure maybe of 10 million, that's a measure in financial terms. The goal should be specific. That is a specific goal. 10, accumulation of 10 million, that will now roll into a drawdown of income that can sustain us. Maybe if you are thinking of retirement or any other form of investment or purpose. Then number 3, it should be achievable. It should be within your means. You should be able to fund the investment, because if you are going to set a goal that is unachievable, you will have spoiled that investment from beginning. Because any other evaluation that you are going to do on that investment, on the basis of whether you are attaining it or not, then it will always give you a negative feedback, and that discourages you. It should be time bound. You cannot do this one forever. Your goal must be achievable and planned for a specific period of time. That in 10 years, in 5 years, in 3 years, I would want to be at this point. Then once you have determined the time and the amount and the measurability, then we should be able to divide it into smaller units for the period to determine what we are putting in the investment on a regular basis. Then be realistic. Then once you have done that, you choose where to be putting your regular savings to build your wealth. That said, you design your purpose and design where you are, then choose a platform that works for you. Question number 2 with regard to money market fund is, why are money market funds promising or yielding the same or higher returns or rate of return as compared to the treasury bills. And this is it. That keenly take when you purpose to invest in any money market fund. And to be precise, we have 29 registered money market funds in Kenya. The first document that you're supposed to ask for is called the fund fact sheet. It's a document that, among other things, gives you the specific areas or instruments that the fund manager will put your money into. One key instrument that you find will be a treasury bill, because in general, money market fund, the fund itself, the fund manager is required in law to invest in short-term instruments that make it easy to liquidate, so near cash items, because the fund themselves by law are not supposed to be on or to have any locking period. Therefore, any investor should be able to access their money. So why or under what ground do these money market funds give us a return that is equal or higher than the treasury bills? And the treasury bills are divided into three. We have a 91 treasury bill, we have a 1day treasury bill, and we have the 365-day treasury bills. Interest rates or returns are based on the period. The longer the period, the higher the rate. So it means a 365-day treasury bill, that is 1 year treasury bill, will have a higher rate compared to the 6-month, that is the 181-day treasury bill, and the least paying bill will be the 90-day, the 91-day, that is a 3-month treasury bill. So these money market funds, they normally benchmark their return that they pay you on the 91 treasury bill, that is giving the least. But is that where they put the money? The fund has benchmarked with a 91-day treasury bill, which is giving the least rate, but they can invest in the 180-day treasury bill or the 365 treasury bill that is giving them a leverage, a range. They are able to get more from the higher treasury bills compared to the one they are benchmarking with. That is one. Because at the end of the day, there is no way a money market fund as a collective scheme, which is a business belonging to another person, that person will be willing you to give you all what they are earning from the investment or give you more than they make. It's impossible. It's never heard of. But because of those who feel that the money market funds that give us higher rates are schemes, or not schemes, sorry, scams. To demystify that, we must now understand where these fund managers are getting the money. And I've already highlighted one option under that. That is, they are benchmarking with the least paying bill, but there are other bills that are paying higher than that, and they are allowed to invest in those ones because those are also in the short-term category. Because under periodicity concept, which is a term in accounting and finance that looks at the length or the number of months that will be called short-term, it covers a period of up to 12 months. That is 366 days. And that's why you have the highest, the longest, or the highest horizon that a treasury bill can have is 365 days. That's number one. Number two is economy of scale. When you are investing in the treasury bills or the bond market, you are categorized, or we are categorized into two as investors. We have retail investors and we have the corporate investors. Depending on which side you are, because to be a retail investor is if you are investing anything less than $1 million. you are a retail investor, a small investor to be precise. If you are putting in more than that, you are considered to be a corporate investor, a big investor. So, one thing that is not available, economically speaking, to a retail investor, small investor, is that room to negotiate for a return. Remember, another product that money market fund, the fund manager we invest in, is framed as well negotiated bank deposits. That part here, negotiated, well negotiated bank deposits. Because the fund manager, having collected money from many of us, millions of us, he has a huge fund. A fund is an amount. He will approach a bank with like 100 million, 200 million, a billion sometimes. They will sit down and negotiate a return. Such volumes are negotiated. So in this case, as a retail investor, you have no room to negotiate. The same when it comes to investing in treasury bills. The size of the fund, the amount that you are investing, and also the duration for which you are investing, that is in the bond market, gives you an advantage in this way. That the amount, if you are putting in more than 20 million, the government can give you a reduced tax rate. Like you're given 10% when others are being taxed at 15%. So as a small investor, you have your 300,000 and you purchase a treasury bill. You will be taxed at a withholding rate of 15%. When the fund manager approaches the same market with 100 million, 20 million, 30 million, depending on conditions and terms of that particular issue or floating, he may get a reduced tax rate. In many cases, it's at 10%. Because sometimes it is based on the amount that you are investing, other time it's based on duration, or both. Because if you are investing for more than 10 years, your withholding tax rate is lower at 10% compared to those investing in a period that is shorter than 10 years. So that gives the fund manager a whopping 5% saving, because remember, withholding taxes, it is not the individual investor who is being taxed. It is the fund manager. And remember, this amount will be withheld. The tax will be withheld by central bank when they are paying the fund manager. Let alone now what has been invested with the banks, what has been invested in commercial papers as equity in private corporate institutions. That is another way. So the fund manager is able to make money or leverage on the volumes that he is investing and durations to achieve higher margins, higher effective margins, because the only thing that we are looking at is not just the interest alone. What other cost savings are you making or margins are you enjoying? And that will determine the ability or the amounts that you can give out as a return. Number 3, which is also important, is competition. In an ordinary market, when there is competition, always either prices will go down or prices will go up to attract customers. The government, in their issue of treasury bills, and the fund managers, they source money from the same market, that is me and you, what is categorically called the domestic market. Therefore, the fund managers, because the government is the primary issuer, the government gives us the primary market. The fund managers, as intermediaries, they are sourcing the money, leverage on the economy of scale that as individual you cannot access. Because if you are able to put in only 20,000, 10,000, which is way below what is required to venture in the primary market directly, you have no choice. You go through the fund manager. but also those who do not want the hustle and the bustle of the primary market. People want to use their time to do other things and then generate more money, because the biggest resource, the greatest resource that you have is time. And you yourself, you are the highest, the greatest asset that you have. There are those who would want their time to make more money, so they don't want to engage themselves in the challenges of the market. And we choose to use the fund managers as intermediaries. In such a case, in order for the fund manager to compete effectively in that market and attract investors towards the fund, he will be forced generally to give a better return than the government. And by so doing, that's why the fund manager benchmarks with the treasury bill rate that is being issued by the government, and at least promises to give you one rate higher than what the government is giving. To continue, hi, give me a subscription to this channel. And in order to make YouTube share this video to other people, give it a like, and we can comment. You can give a comment that will trigger more information, or we can share on this financial journey. You can also share this information to another person. So welcome to my channel, and we'll discuss question number 2 after this 2-second break.